Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on the 11 megatrends of 2008, brought to you in association with ASB. The third megatrend, we believe, for 2008 was the biggest and fastest fall in the official cash rate in the history of New Zealand's monetary policy. We saw the official cash rate drop from on July 23, 8.25% to 5% just 5 months later. Who would have thought back on July the 23rd that interest rates would be this low? But they are, because the Reserve Bank has acted aggressively to try and restart the economy as it fell deeper and deeper into recession through 2008, and to try and avoid an even deeper and longer recession through 2009. The jury is out about whether that's been achieved or not, but certainly the Reserve Bank has used its main tool hard to try and get the economy going again. Let's just look back and see what happened over the course of the year. July the 24th, we saw a moderate cut, 25 basis points in the official cash rate by the Reserve Bank Governor, and comments that more cuts would be needed. But everyone then thought that cuts would come in the form of 25 basis points. Then Governor Alan Bollard surprised everyone on September the 11th with a 50 basis point cut. It really shocked everyone into realising this was going to be a long and hard recession. But more was to come. October the 23rd, just over a month later, 100 basis point cut in the official cash rate. At that stage, surprising not too many people, they'd all started to believe that interest rate cuts could come in more than 25 basis point chunks. And sure enough, December the 4th, just 2 or 3 weeks ago, we saw the official cash rate cut by a record 150 basis points. However, the Reserve Bank Governor said then he wouldn't be cutting by nearly as much next time, that the increments would be a bit smaller. What we saw through the course of the year was the economy slip into recession right from the start, partly because of the drought, which hit our agricultural production, but also because of the housing downturn, which came a little bit earlier than in some other markets, although not the US market. That affected consumer spending. Many homeowners didn't see their homes like big ATM machines that they could withdraw money from all the time, and they stopped spending. And that's had an effect on the economy. So, what happens from here? And what's going to happen to interest rates that we pay and we receive in the form of mortgages and term deposits? Well, in the mortgage area, not all of the 325 basis points of cutting in the official cash rate has been passed on in variable mortgage rates. We've seen just 250 basis points cut of the 325 that's come to us from the Reserve Bank. The banks are all facing higher lending costs, funding costs, because of the money they've borrowed overseas is more expensive, and they're trying to protect their margins. We've just seen the Reserve Bank Governor come out and say the banks needed to help out more with the economy. From here though, most people expect the official cash rate will drop as low as 4%, or possibly even lower by the middle of 2009. The next chance we'll see for another cut in the official cash rate is January the 29th, when most people are saying we could see a 50 basis point cut. What does this all mean? Well, if you've got a fixed rate mortgage and you're thinking what's happening to interest rates in the next 6 to 12 months, on the whole, they're continuing to fall. So it makes sense to go short, to look at 6 month, 1 year, maybe even a variable rate mortgage, depending on what works for you. For savers, of course, it's a different story. Interest rates are falling and falling fast, so it makes sense to lock in for as long as you can, for as high as you can, although it's going to be tough. I'm Bernard Hickey. That was a special report on the 11 megatrends of 2008, brought to you in association with ASB.